Right. Well, good morning, everyone. My name is Alex Chausovsky. I'm the Director of Analytics and Consulting at the Bundy Group. And welcome to The Reaction. It's a placeholder name for now. We're just trying this out. But today I am joined by my colleagues in the economic analysis field, Dr. Sarah Ali and Nadia Vanderhal. I'm thrilled to be here today. We are going to be reacting to the latest JOLTs report from the Bureau of Labor Statistics. And hopefully we'll put it into context for you, explain what the numbers mean, what they don't mean, and most importantly, what the implications for you as a decision maker and leader should be. So with that in mind, I will turn it over to you, Sarah, for your take.
Thank you, Alex, so much. And Nadia, nice to see you again as well. A little bit about myself, actually, a quick introduction, if that helps. So Sarah Ali here, applied economist by training, 17 years of experience in the public sector, private sector, academic, and nonprofit space. Currently the VP of Economic Forecasting at the Indiana Economic Development Corporation, and also an adjunct professor of economics at Washington University in St. Louis, and a math professor at campus in New York City, always keeping myself busy. But to the jobs numbers for today, I had three observations at a high level. I do see a loosening of the job market, but I do think it's very marginal. And I'm using the word marginal in economics to indicate, a small change. And then I looked at some of the job openings also for the sectors of information, retail, trade, and healthcare. And my takeaways are the following. On information, I did notice that there's been a large gain in quits month over month. And, one of my hypotheses is basically trying to understand why is this happening? And I think personally, it might have to do with the large tech employees or employers, asking their employees to come back into the office. We've been seeing that over the news cycle, right, for the past year, but I think it's really jumped up. And then, with respect to retail, trade, and healthcare, it's funny because these two industries are really different, but the trend that I keep seeing is that people have to be in the office. People are working longer hours. It's just harder conditions. And I think a lot of the big employers like the Walmarts and the Targets, right, versus the Aetnas and the Kaiser Permanentes are really going to have to step back and look at, the working conditions and try to figure out policies that keep people in the jobs. And that's, what I'm seeing right now in the JOLTS numbers.
Fantastic, Sarah. Thank you so much. Nadia.
Sorry, I had to sneeze. My name is
Bless
Nadia.
you.
Thank you. My name is Nadia Vanderhal. I am the founder of the Brands Advanced Strategy Group. I'm pretty much a financial planner who just makes common sense of what's going on in the economy and world economy into the wallets of consumers. So one of the things that I have been noticing when it comes to these reports is something that I've said. The reports don't often match the reality. When this report is actually being the one that is showing the true story right now. But the thing that I wanted to call out within my analysis that I shared was that the median change of the annual pay was roughly 5.7% compared to the lows that we saw last year or in 2021 of 5.6% in September of 2021. The thing that I called out recently over on LinkedIn was how the city of New York brought back a lot of jobs. They called that out. But one of the call outs that I had is that the rate of the jobs coming in is good, but the quality of it is not matching the economy. Meaning you're seeing the jobs come back, but you're not seeing the rate in which the pay is matching what inflation is having, how is it increasing the cost of living, and how people are able to afford their livelihood. And I think that's one of the things that we are noticing with inflation is, yes, it's starting to dip, but it's not really showing the full circle of how it connects to people's wallets. But the thing that the forecast can typically do in anything is that it can miss. And this one, it was a big miss. And I want to see what's going to happen with the report that comes out on Friday to show the full story. Because one of the things that I've said in corporate, I've worked for financial institutions in the past, is that the data shows a decision and it tells the story. So are we going to see on Friday that the story is full circle, or is it going to have some moving parts? Because everyone keeps talking about the soft landing, but it's not giving it's giving kind of floor, but not a pillow. And I'm just really intrigued to see what it's going to do, because the theme that I've been calling out is stagflation. This is giving stagflation. And while we're not seeing recession, it's giving stagflation. And this job report confirms that.
Fantastic. Yeah, that cement floor will still hurt a lot if there's not a pillow to land on, right?
Yeah.
Great. Thank you both very much for sharing your viewpoints. My take on this is essentially, first and foremost, keep in mind when you see these numbers that you have to question the validity of the data, right? The JOLT survey right now has a participation rate of about 32%, which is not statistically significant by most standards. And so take those numbers with a grain of salt. I think they're representative of kind of directional movement. Yes, the labor market continues to be slightly cooler relative to where we were in 21 and 22, but certainly still very tight from a lot of different perspectives. If you look at, for example, the unemployment rate overall, 3.8%, and the specific jobs, management positions, 1.6% unemployment, engineering, accounting, somewhere around 2%. So the devil is always in the detail when you look at these numbers, right? The other thing that I will say is that the delta or the gap that exists between the number of open positions and the number of people that are actively looking for it remains very large, over 3 million people today in early November. And so it's really key to understand that any organization, as they plan for next year, especially if they're planning for slower demand conditions, like a weaker economy, have to keep in mind that labor is going to continue to be a challenge. This is going to be, in my view, the first time that we have a meaningful economic slowdown, and in some cases, parts of the economy will be in outright contraction, but it's not going to be accompanied by the kind of layoffs that we typically see in a recession. So you've got to be really good at attracting, but more importantly, retaining the people that you have. And paying them fairly is a key element of that. That's what I featured in my LinkedIn post today, is make sure that you understand what the competitive rates are today for whatever position that you're hiring for, and you make educated decisions based on that market data in terms of the COLA adjustments, that's cost of living adjustments, in terms of the merit-based increases you're giving to your folks, and make sure that they are paid correctly relative to what the market demands today. So that were my key observations. And again, Sarah, Nadia, thank you so much for joining me. It's been a great experience. I hope to do these more often in the future. And thanks to all of you for tuning in. Have a great day, everyone.
Thank you.
Thank you.
Okay.